Okay, good afternoon, everyone. My name is John Barnett. I'm a tax lawyer and I chair the Chartered Institute of Tax's Tax Policy Committee. Just a brief introduction to this debate today. The Chartered Institute of Tax is the leading professional body for UK tax advisors. And on behalf of CIOT and our partners for this event, the Institute for Fiscal Studies, I'd like to welcome you to today's debate. It's great to have people in the room in Manchester. It's great to be back in person together. And it's also great for those people online who can hopefully see us on the camera, that this event has been opened up to you as well. It's been an interesting 18 months, but hopefully we'll come out of it a bit better. This is the ninth CIOT and IFS time. The ninth time CIOT and IFS have held a joint debate at party conferences. We do this because both organisations share the aim of promoting debate on tax and related matters and improving public understanding of how the tax system works. A brief advert first and then we'll get on to the session proper. This is just one of the ways in which CIOT do this. We also have our low income tax reforms group, which publishes information for taxpayers on how to navigate the tax system. And its website is used by more than 5 million people a year, which gives some insight actually into how many people there are out there who really need to understand tax. And for the IFS, their outstanding new tax lab, an online resource containing all sorts of useful explanation and data on the UK's tax system. So, advert over. Today's debate is on the taxation of wealth. Obviously, we all know during the pandemic, UK government borrowing has soared to levels most people would regard as unsustainable. The government's already announced increases to corporation tax and national insurance, and in a sense to income tax as well, by freezing of allowances and thresholds for 5 years. But will more be needed? Increasingly, we hear calls, including in Parliament and at last week's Labour conference, for a wealth tax. Ultimately, of course, that's a political decision, but CIOT and IFS both think that debate should be informed by an understanding of how such a tax might actually work, the practicalities, the likely behavioural effects, as well as how much it might actually raise. How easy would it be to introduce? Who would pay it? Should it cover all wealth or should there be exemptions? And would it be better than the alternatives? For example, improvements to the ways we already tax wealth and capital, such as inheritance and property taxes. Last year, you may have seen a wealth tax commission looked into these questions in impressive detail, and I'm delighted that one of the wealth tax commissioners, Emma Chamberlain, is on our panel today. As well as the Wealth Tax Commission, the cross-party Treasury Committee took evidence from Emma and others for its report on tax after coronavirus, published in March. And I think possibly to the surprise of many of us, given there was a Conservative majority on that committee, it didn't rule out a one-off wealth tax. It noted the arguments for and against, and I'm delighted that Felicity Buchan, one of the members of that committee, is also on our panel today. I'm also delighted to hear recently that Felicity was appointed as a PPS at the Department of Business recently, but she will say more about whether she's talking on her own behalf or not later. And to introduce the topic in a second and provide some context on how we tax wealth, we have the IFS's Senior Research Fellow, Senior Research Economist, Stuart Adam. So, the format for today, we'll begin with opening remarks from our three speakers, and then the floor will be open for general discussion, and audience members will be able to contribute and post questions to the panel. If you're watching live stream, or indeed if you're in the room, there is a Slido for questions. George, I don't know if we've got the Slido number for people in the room or just for people online.
There'll be a link.
There will be a link. Okay, there'll be a link above the screen for people online. So if you're watching the live stream, please table your questions via Slido. And you are encouraged to upvote questions. I'm not sure that upvote is a verb, but apparently it is these days. So if you like other people's questions, then they will get towards the top of my list on the screen here. And if you want to tweet, use the hashtags CIOT, IFS Debates, and CPC 21. So, without further ado, our first speaker will be Stuart. Stuart Adam.
Thanks, John, and thanks for coming, everyone, or for tuning in online, as the case may be. As John said, recently, over the past couple of years, there's been more and more discussion of the idea of introducing a tax on people's wealth holdings. I think there are two main reasons for that. One is the general feeling that we might need to raise more revenue from somewhere. There's obviously been a huge one-off cost of supporting the economy during COVID, and COVID will have longer-lasting after effects as well. But that's coming on top of big, longer-term challenges that look quite expensive, from tackling climate change, getting to net zero, to the costs associating with an ageing population, to the challenges of levelling up. Now, the Chancellor has recognised all this, and this year we've seen announcements of big tax rises, about £40 billion a year of tax increases announced this year. Given the scale of the challenges facing the public finances, my guess is that more fiscal tightening at some point is likely to be needed. Now, that doesn't necessarily have to mean tax rises, that could mean spending cuts, or it could be a combination of the two. I don't have a particular view as to which way you should go on that. But whether or not you raise more in tax, there's always a question for however much you raise, how much of it do you take from different groups? And in particular, should we be looking to raise more of our revenue from the better off? And politicians of all parties have talked about those with the broadest shoulders bearing the burden. And so that brings me, I think, to the second reason why there's been more talk about a wealth tax, which is that wealth has become more important. Because of rising house prices, other rising asset prices, wealth has just become bigger relative to income. It's a more important part of the economy. And wealth has also been becoming more unequal over time. Now, again, I don't have a particular view as to how redistributive the tax system should be. The question I want to address today is, if you wanted to raise either more revenue or just more of our revenue from the better off, would a wealth tax be a good way to do it? Before I give my answer to that question, I think it's worth putting a bit more definition on the question. What exactly are we talking about taxing here? So I think the first fact to keep in your mind is that about 3/4 of the UK's total wealth is people's houses and pensions. That gives you a sense of scale, and that's true across most of the population, most of the distribution, until you get to the very, very top. And that raises an obvious question as to whether you would want this to be taxing all assets, or whether you'd want to have exemptions in for some things, and tax only a narrower definition of wealth. It also leads obviously onto the question of who should pay it. How high should the threshold be before you would be affected by a wealth tax? A tax that affected millionaires is a very different proposition from a tax that affected billionaires, and both of those are very different propositions from a tax on so-called ordinary people's houses and pensions and so on. And that makes a difference not only to which taxpayers we're talking about, but also what kinds of assets are involved, how much revenue is potentially at stake, and how people would be likely to respond if you did introduce a wealth tax. Now, to give a rough sense of scale, again, some figures to have in your mind, if you set the threshold for a wealth tax at £500,000, that would affect about 8 million people. So that's around 1 in 6 adults in the country have total wealth, again, including housing and pensions and everything, of more than £500,000. To get at the top 1%, you'd be looking at a threshold of around £2 million. So that's about 500,000 people. If you set the threshold at £10 million, then you're talking about 20,000 people or so. So that's 0.04% of the population, 1 in every 2,000, 2,500 adults in the country. And obviously, so a higher threshold will mean you're affecting fewer people and richer people, but of course it also means that there's less potential revenue available. So I'm not going to talk about which of those kinds of wealth taxes and the many other design features that we could get into details of, but whichever of those you're looking at, if you wanted to tax the better off more, is a wealth tax the way to do it? Well, the attraction of a wealth tax is obvious. I mean, after all, if you want to tax the better off, aren't wealthy people better off almost by definition? Well, actually, I think it's not quite as clear as that. First of all, a lot of people's wealth is determined just by what stage of their life they're at. People in their 20s don't generally have very much wealth. People tend to build up their wealth over their working lives, and they at some point may inherit some money if their parents die or whatever it may be. And people's wealth tends to peak around retirement age, at which point they start to kind of draw down their wealth a bit. And so differences in wealth between people in the cross-section reflect just what stage of life people are at, as much as how well off they are over their lifetime as a whole. But putting that aside, even if you're thinking about people with the same level of wealth, well, if you were taking a snapshot of the population and doing this as a one-off thing, you can see why you might just say, okay, the people with more wealth are better off. But now think of doing this every year. And you take two people of the same age with the same level of wealth who are otherwise identical in every way, and in the first year of the tax you levy the same level of wealth tax on both of them. But then one of them spends all their money and the other one keeps it. Well, the one who spends all their money won't pay any wealth tax in subsequent years, whereas the one who keeps it will pay tax on the same wealth over and over again every year. And again, it's not clear that that person's any better off over their lifetime. They're just choosing to save their money and spend it later rather than spending it now. And so that, for me, is the fundamental question for proponents of an annual wealth tax. If you want to tax people based on their lifetime resources, the way to do that is to tax everyone on their wealth once when they get it, when they earn it, or maybe when they inherit it, whatever it may be. And the question is, why would you want to tax that same wealth over and over again, tax people more the longer they hold on to it? Now, there are possible answers to those questions. Economists don't all agree about wealth taxes, and there have been generally fairly subtle arguments proposed for why you might want to levy higher taxes on people who save. And they can be things like saying, well, if actually those people who save tend to be people who are more patient and more intelligent, whatever else, then maybe actually you can get at taxing people who are more able to earn a lot of money over their lives without actually having to tax their earnings as much and therefore discourage them from working as much. And that's one of half a dozen arguments that are around in the economics literature as to why you might want to do it. There is some merit in those theoretical arguments. There are also some arguments the other way. Personally, I'm not convinced that those give me a good enough argument for wanting an annual wealth tax, particularly when you move away from the kind of these conceptual theoretical issues and look at the potential practical difficulties with a wealth tax, the difficulties of actually valuing certain forms of wealth, the potential for avoidance and so on, particularly if this was a wealth tax that had been through the political process and ended up with various exemptions and so on. I think my view would be that if you're trying to tax people with high lifetime resources, the way that you would want to do that going forward would be to tax all wealth once when it's received, or for that matter when it's spent, rather than taxing it every year. My impression is that a lot of proponents of a wealth tax are actually really trying to get at large inheritances or get at people who made very big fortunes through a business and paid very little tax on it, or people who've seen their homes rise enormously in value and therefore, as it were, have seen a big rise in their wealth without, as it were, earning it. And you can make arguments for and against each of those. I think my view would be whatever of those you want to do, you can actually do it more directly than by having a wealth tax. And that brings me to, I think, the key takeaway that I'd like to get across, which is I would like to fix the existing taxes we have on those flows of income and spending and so on. Now, I hate to break it to you if this is news to anyone, but the existing capital gains tax, inheritance tax, the way we tax dividends and pensions, the way we tax property through council tax and stamp duties are all really flawed. They all have quite big problems, and I think there is a lot of work to be done fixing those. And if you wanted to raise more money from the better off, and actually, frankly, even if that wasn't your objective, that's where I would start. And I think there's a lot of good stuff that you can do. I won't take time to go into those individually now, but I would be delighted if we get into those conversations in the Q&A afterwards. The final point I want to make is that I've been talking so far about an annual wealth tax. A one-off wealth tax is a very different beast. And actually it's had more positive views expressed about it by both the Wealth Tax Commission and the Treasury Select Committee report on this. It avoids a lot of the disadvantages of an annual wealth tax. It doesn't avoid, the difficulties of doing a valuation of everyone's wealth, for example, but if the Chancellor unexpectedly announced that he was going to impose a one-off tax on the wealth that people held on that day, you wouldn't have any of the problems of discouraging saving or enterprise. There wouldn't even be issues of avoidance and people moving their wealth offshore, because as long as it's based on your wealth at a date that's already gone, it's already too late for you to do anything to reduce the tax liability. And so in that kind of pure economic efficiency sense, it's quite an efficient way to raise revenue. I think there are two key challenges for this. One is, can you really do it in a way that's unexpected and believed to be one-off? Because if people start thinking you might do this, or if you do it and people start wondering whether you're going to do it again or what other taxes you might bring in, suddenly it can start having those disincentive effects on people's behaviour again. The second challenge, which I think is a pretty open question, is it fair? So, to some extent, again, this clearly is taxing those people who have more wealth at this point in time. You might make the argument that actually maybe we didn't tax some of those incomes and some of their inheritances or whatever in the past in the way that maybe you think you ought to have done. And again, how you ought to do that is a debate in itself. An obvious point here comes back to something I was saying earlier, that a lot of people's wealth at any point in time reflect what point of their life cycle they're in. So if you do a one-off wealth tax, you're basically hitting mainly people around retirement age. And again, people will take different views as to whether a tax that is particularly targeted at that cohort, that generation, is a good idea or not. And again, we can get into that discussion, but for the moment, I will leave it there and hand over to Emma.
Great, thank you very much, Stuart. I'll introduce Emma in a second, but actually I always think that the most interesting part there is that in order to be successful, it has to be credibly one-off. And I've yet to meet a politician who can find something successful that is credibly one-off, because there's always a bit of a temptation to do it again. But anyway, with that in mind, let's move on to Emma. Emma's a barrister at Pump Court Tax Chambers, and as we said earlier, was one of the three commissioners of the Wealth Tax Commission, which reported in December 2020. And just in the interest of full disclosure, she's also joint chair of one of the CIOT's committees, the Private Client International Committee. So, Emma.
Thank you. Good afternoon, everyone. Well, clearly there is a live debate about how and to what extent we need to raise revenue. And can we do it through capital taxes? And it's certainly fair to say that capital taxation has not had a good record in this country, and actually I'd say in most OECD countries. We don't raise a lot of money from inheritance tax, and the capital taxes, we raise a lot more from income tax and national insurance and VAT. So any politician thinking about capital taxes would need to think that the game is worth the candle, if that's the right way of putting it. However, when you have times of crisis, you always get the wealth tax idea bandied around. And this happened during COVID and in March, and I was asked whether I would be part of the Wealth Tax Commission. The other two were academics, and I thought it was probably useful to have a tax practitioner on the commission as well. And we decided to look at it in more detail. And it's worth reflecting that it's 50 years since Healy tried to introduce his very ill-fated wealth tax, and life has moved on. And has anything really changed to make it more feasible? What we did was go around commissioning experts from both the tax profession. In fact, John wrote a report on administration, and the IFS were also involved on the economics. Very detailed papers. We looked at we had international experts as well, looking at design, avoidance, valuation issues, liquidity. And part of it is a sort of academic resource that anybody can look to. So anyone who wants to look at the pros and cons and difficulties of a wealth tax would hopefully find those papers, which are on the website of the Wealth Tax Commission, pretty interesting. Conclusions. Well, we did not recommend an annual wealth tax. Stuart will be pleased to hear. And there were a variety of reasons for that. I think essentially one could never really get over the valuation and liquidity problems, even leaving aside the economic issues about you're taxing people just because they choose to save at a particular time rather than spending more. And just the sheer administrative complexity of a wealth tax added to our already very over-complex capital tax system did not really make a lot of sense. What we did look at, though, is that if the government, and it is a sort of conditional recommendation, if the government did choose to raise taxes, it could implement a one-off wealth tax, and it could raise quite a bit of money. And that is an exceptional levy based on wealth above a certain threshold, I'll come back to that in a minute, based on an individual's net worth after debt, levied by reference to one valuation date. So that's the key difference, is you do it by one valuation date, but it may be payable in instalments. And we recommended that if you did do this, you would have at least 5 years over which to pay a one-off wealth tax. And the relevant date for determining the value of your wealth would be a date fixed at the date of announcement or shortly before the announcement. And although it would be levied on an individual basis, you would be able to elect to be taxed on a household basis, so that, for example, just because spouses chose to hold wealth in a particular way, they wouldn't be unfairly penalised. They could elect to be taxed jointly above a certain threshold. Now, contrary to the media reports at the time, because it came out in December, we did not recommend any particular rates or thresholds, partly because we were certainly not going to agree between ourselves on what those rates and thresholds were going to be. And anyway, that is really a political decision. All we did was pose various thresholds. So, for example, if you had a threshold of above 500,000 per person, so $1 million per household, at a flat rate of 1% payable, 5% payable 1% every year for 5 years, it would raise, estimated, and it is only an estimate, of about 260 billion, but it would affect 17% of adults, so an awful lot of people. If you had it at 2 million per individual, so 4 million per household, you'd raise more like 81 billion, and you would still affect the top 1%, so you'd still affect about 600,000 of adults. So we gave a range, and in fact you can go on the website and amuse yourself by working out how much wealth tax you would pay at various different rates, and key in your own wealth, and that's a sort of wealth tax simulator you can use. The one thing we did agree on was that it should apply to all assets, and Stuart has made the point that 2/3 or 3/4 of all assets are in houses and pensions. Slightly depends on the threshold you're looking at. But in the interests of both fairness, avoidance and revenue raising, we thought that exempting certain assets would be a recipe for disaster. And one of the problems we have with our capital tax system at the moment is that we have a lot of exemptions, and people obviously go into those exemptions because they don't want to pay the tax. So if you have a broad-based tax, you are much less likely to end up with avoidance activity. There is also an issue of fairness. Why should someone who happens to have their wealth in financial assets pay more wealth tax than someone who might live in a bigger house, for example? So there are issues there. Controversially, we also felt that pensions should be included, but those people would not pay a wealth tax until they retired, so they would have an additional deferral period. Now, Stuart's also mentioned the difficulties about is it anticipated. We weren't so worried about that, because even if it is anticipated to some degree, the amount of forestalling you can do is to some extent limited. Does depend a bit on the thresholds. You can give your assets away, but that's not necessarily a bad thing. Generally, the Conservative Party like people to hand on wealth down the generations. And those may have inheritance tax or capital gains tax consequences. People might say, oh, well, you might go non-resident, but we said that anyone who had been UK resident for 4 out of the previous 7 years would still have to pay it, but new arrivers would not have to pay it in the same way, so they would get some relief. And then the issue is, can it be credibly one-off? Well, of course, it's worth remembering that Thatcher did have a one-off tax on banks because they had benefited from high interest rates. We had Gordon Brown, who had a one-off tax in 1997. The Ireland introduced a one-off pension levy, and nobody seemed to suggest that that was the end of the world. And Germany also had a one-off wealth tax, actually, as well as an annual wealth tax. But I'm not convinced that you can't, if you're credible about it, say that it is one-off and make sure it's one-off, partly because a one-off tax has to be designed in a different way from an annual wealth tax. The geography of it, some of the objections we got, and you can see some of the frequently asked questions on the website. People said, well, won't it affect people in the south? That very much depends on where you set the threshold. If you set the threshold at 2 million, then it is fairly evenly distributed. If you set the threshold at 500,000, it will affect people more in the south. Popularity, well, we did there was some quite detailed analysis, and in fact, even Conservative voters were keener on a wealth tax than any other form of tax rise, and it wasn't just Conservative voters who wouldn't have to pay it. So actually they were keener on a lower threshold, including the House, which is quite interesting when you really examine what those surveys were throwing up. And the reasons for it, they said, well, the wealthy, the rich have basically pay more, don't pay enough tax, and it's better to tax wealth than work. But there was also, in those pollings and the analysis we did, considerable scepticism about whether you could really make a wealth tax work, or would it be subject to avoidance. And I think one of the problems on an annual wealth tax, quite apart from valuation, liquidity, and the economic issues, is avoidance. Because if everybody knows it's going to come up every year, and you set it, for example, at a high threshold, you are going to be pretty open to avoidance. People will do things like fragment their wealth and they'll give it away, and before long your tax base will get very, very fragmented. So I think a one-off wealth tax presents certainly different challenges, but is much less prone to avoidance, even if to some extent it is anticipated. We were against an annual wealth tax. I think there are, out of 12 countries that originally had it in the 1990s, only 3 are left: Switzerland, Norway, and Spain. It doesn't raise much money in Spain and Norway, raises a bit rather more in Switzerland, but you've got to remember Switzerland has a much simpler capital tax system, and the annual wealth tax there is really doing service as a sort of capital gains tax on unrealised gains, because Switzerland doesn't have capital gains tax and it doesn't really have inheritance tax. So it's a very much simpler system, and it operates at a cantonal level, so rather easier to enforce. So we were not keen on annual wealth taxes. We did like Stuart suggests, recommend reform of other taxes. It's fair to say we weren't exactly agreed on what the reform should be on other taxes, and of course this is the problem. But certainly there are issues we can discuss on inheritance tax and capital gains tax, which could certainly be improved. So in conclusion, one-off wealth tax is possible. An annual wealth tax is very difficult. We would suggest that you have reform of existing capital taxes, and I think that in order to have meaningful reform of capital taxes, you really need a roadmap, a bit like George Osborne had on corporate taxation. So a sort of structural plan so everyone can see where we're going and what we're trying to achieve. And I also think really on capital taxes, particularly a tax like inheritance tax, you need some form of political consensus. Because one of the problems that you face is, as a government, you can reform inheritance tax, but you may only be in power 5-10 years, and people may hang on. And of course that was the problem for capital transfer tax. Everybody knew the Conservatives would change it when they came in, and so they delayed making gifts, and some of them even tried to delay dying. So
we all try and do that.
So in conclusion, there's a lot to be done, but it's not easy, I think.
Great, thank you very much, Emma. We'll move straight on to Felicity. Oh.
Excellent. I think a few people at the back cannot see me. I'm quite short, so let me stand up. First of all, I just want to make clear that I'm talking in a personal capacity and not on behalf of government. And I should also say that I am not a tax specialist, so I am coming to this from a financial and political background rather than my esteemed colleagues who do have a tax background. I want to be very upfront that I am anti-wealth taxes, whether they are on an annual basis or a one-off basis. And that's for three principal reasons. One is philosophical, which I will move on to. The second is practical, and Emma and Stuart have already alluded to some of these issues. And the third is the signalling effect. So let me start with the philosophical reasons. First of all, I believe that the tax burden should not be increased any further. Certainly in today's circumstances, if we have another crisis, we may have to adjust. But as of today, I think the tax burden is as high as it should be. We had to make very difficult decisions on corporation tax, on freezing the thresholds, on national insurance. But I fundamentally believe in a low tax economy. And so, yes, we've had to increase certain taxes, but I personally feel that this should be the maximum of the total tax burden. I also have got a big issue with wealth tax because this money should already have been taxed, whether it's income tax or for any other taxes. And I know that certain taxes may be imperfect, as you alluded to, Stuart, but it all sounds to me like double taxation. And if it is not being taxed properly at source, then that is a different issue that we need to resolve. I also am very concerned that wealth tax does not in any way correspond to one's ability to pay the tax. I've got a central London constituency, and property prices there have gone up substantially over the course of the last 20 years. But often people do not have large incomes. Now, clearly in the long run, they are the beneficiary of this wealth appreciation, but in many instances, they simply would not have the ability to pay this wealth tax. So that's my philosophical disagreement. The second, and as important, is the practical issues. I think it's very interesting. Emma's already alluded to the fact that very few European countries have a wealth tax. But I think that the European example is even more powerful because so many European countries have actually got rid of their wealth taxes France, Germany, Austria, Denmark, the list goes on. And they got rid of them because they simply were not working. It's also interesting that the OECD has come out against wealth taxes, and I believe, Emma, in your report, you said that a 1% wealth tax would probably reduce the tax base in the order of 7 to 17%.
A one-off wealth tax.
Yes.
It depends a bit on the threshold and that sort of thing. Yeah.
Yes. So I think if you look at the international comparisons, they're very much so anti this from a practical perspective. Now, just talking about what can go wrong with wealth taxes from a practical perspective. Well, the first is that they can discourage savings. Let's say that you put a wealth tax onto pensions. Now, we all try and encourage people to save for their retirement. But if you put a wealth tax onto pensions, then that leads to perverse consequences. Secondly is capital flight. Capital could be redirected abroad. Secondly, capital could be deployed inefficiently. So let's say some assets attract a wealth tax, others don't. Then you are being steered to invest your resources in one direction, which may not be economically efficient. And then there is also issues such as valuation. A lot of property, we haven't changed council tax bands for the last 20 years because of issues with valuation. What are you going to do? Are you going to go out and value every single property, every single ring in someone's jewelry box? There are massive issues when it comes to valuation. And then I think what is also very important is the signalling effect. We want to be encouraging entrepreneurs, those who want to set up businesses, to come to this country, to invest in this country, to create jobs, and to create taxation for the exchequer. Because if we have people who are investing in this country, we will get so many more taxation revenues. If you think back in the 1970s, a wealth tax was mooted. We didn't have one then. I think if we didn't have one then, the signalling effect of having one now would be very, very bad. So my view is very, very strong here, that I do not think wealth taxes work for this country. I want us very much so to be a forward-looking country. Europe is abandoning wealth taxes, or has abandoned wealth taxes in the large. I would also say that we already tax wealth. If you look at our property taxes, capital gains tax, if you look at our property taxes, including council tax, we have some of the highest property taxes in the world as a percentage of GDP. And it's interesting that the cases that Emma alluded to are there in those countries. They have way lower property taxes, and in several cases, no capital gains tax. So yes, we can make taxes more efficient, but my view is wealth taxes are not the way to go.
Thanks very much, Felicity, and to all our speakers. So we're going to open this up to questions now. So those people who are online, I do encourage you to submit your questions via Slido and vote on other people's questions. The ones that get the most votes will be towards the top of the list on my screen here. But we'll take a couple of questions from the room first, and we'll then take the questions from Slido. So we'll take two together. So we'll take the gentleman with the pink tie and the gentleman at the back.
I'll happily go first and then hand over to Greg, if that makes sense. Yeah, I do want to say I do fully agree with what Felicity said, but I want to highlight maybe an area other than Europe where wealth taxes are far more prevalent. So some of my practice is an international tax, and they are very prevalent in Latin America. Now, no one can accuse Latin America of having low inequality, and I think one of the things when it comes to the politics of this is when people hear wealth tax, they hear lowering inequality, when the experience in Latin America and elsewhere where it's been tried has not been the case. I think one of the issues with that is the credibility argument. I think it's very easy to point out individual cases where one-off taxes, windfall taxes have been used and not led to a freezing effect, a signalling effect. But you've got to remember, income tax was introduced as a temporary tax to beat Napoleon. And yet that's still with us 200 years later. Now, nobody, I don't think in this room is suggesting abolishing the income tax. But things do stick when there are one-offs. And I think one of the points that Emma made correctly was that a roadmap on corporation tax has been very helpful to build up confidence as an investment environment. And the reversal of that actually creates a freezing effect itself, as would any one-off wealth tax. So I'd be really interested to hear from any of the panel as to how you can afford credibility, rather than just saying it's going to have a credibility or not based on experience elsewhere. What would politicians have to do? Because I'm really skeptical it's happened elsewhere.
Okay, we'll just take the second question and then we'll open this up to the panel.
Thanks very much. And I was going to illustrate a point. The area I represent on a council is the epicentre of the French community in the UK. And I can't tell you how many times somebody said to me on the door that they're living in the UK because of the wealth tax in France, François Hollande, or even Monsieur Mitterrand back in the 80s. And these people have settled in the UK because of the high tax regime in France. And it was mentioned on the panel that this mobility is there. But what signals would it send to our wealthy people who are so mobile if we had a wealth tax? How many of them would fly to other countries?
Great. Emma, do you want to go first, maybe?
Well, I do think an annual wealth tax would obviously have a behavioural effect, and it's one of the number of reasons why it wasn't recommended. And I was very careful actually not to mention the word inequality as a way of in the context of wealth tax. I know that is mentioned elsewhere. I was looking at it more as a revenue-raising measure, and if the point is you don't want to raise more revenue in that particular way, then obviously a one-off wealth tax wouldn't be relevant anyway. I'm more sceptical that a one-off wealth tax would lead to a lot of behavioural response, because what would happen if someone emigrated? It wouldn't actually mean they don't pay the one-off wealth tax, because if they'd been resident in 4 out of the 7 previous years, you could obviously choose a different figure, they would still pay. I think there is an issue about signalling. I certainly agree with that. It's just a balance, isn't it? I mean, every tax rise sends a signal, and it's a question of what signal you want to send. National insurance rises send a particular signal as well. So I don't think that can be underestimated. I'm less bothered about the one-off side. That's up to politicians ultimately. And I'm not a politician, but I think that politicians ought to be able to credibly say this is a one-off tax, and they have in other countries in the wealth tax context. And the other thing that might really focus their mind is that they won't raise any money if they have an annual wealth tax, because it will just simply go in, or they won't raise enough to make it worthwhile. But that was actually one reason why we suggested that you shouldn't have to pay a one-off wealth tax over more than 5 years. Because if you have it over, say, 10 years, which some people suggested, because you get the ability to pay inheritance tax over 10 years, you would end up with the government getting too used to that income. So, and there would be some incentive to pay the one-off wealth tax up front rather than over a period of 5 years. But I mean, in a sense, it's a conditional recommendation. If you want to raise money in a particular way, this is a better way than raising it in other ways. But I'm certainly not saying that the tax base should necessarily increase. It's just that if you did want to increase it, this is one way you could do it.
Stuart, Felicity, do you want to?
Yeah, so in terms of would a wealth tax be credibly one-off, and could you make it credibly one-off? I agree that it's hard. I don't think it's a binary yes, no, would people believe it, would people not believe it. I think, there may to some extent be a question of how far people believe it, and the closer you get to that, the closer, the more of the advantages you get. There are also things that governments can do to make it a bit more credible. So one is just, for the government that does it to commit very openly and publicly, and you can vote us out if we do this again. Now, of course, that might not work for if the government changes, but then if the government changes, there's any reason to believe they do the same as the previous government did anyway. I think it's also more likely to be plausibly one-off if it's linked to a specific one-off event. So actually some of the one-off wealth taxes that other countries have successfully had in the past have been one-off taxes to pay for wars. In the aftermath of a war, you can do that. People have made the same argument about COVID, that it's kind of so clearly a one-off event that we say we have a one-off tax to pay for the debt that we've incurred supporting the economy through the pandemic. It may be more credible. Now, again, I don't think it's quite as binary as that. People might then wonder, well, okay, but what about the next crisis coming down the road? People were talking after the financial crisis a decade or so ago about one-off taxes on banks or bankers or whatever. And so, and I think that's the broader point that I would make, is it's not actually just about whether the wealth tax itself is perceived to be one-off. But if you're a business and you start thinking, well, is this the kind of government that might suddenly and unexpectedly impose a tax rise on me, on my business, would that make you more wary of coming to the UK, investing in the UK or whatever? But of course, that's not just something about a wealth tax. That's a general point about having a stable and predictable tax policy, and that's something that applies more widely. I don't think that it's unique to a wealth tax to say it might make people worry about other future possible taxes. So I don't think it's quite as black and white as this. I think it's kind of, it's shades of grey, and what are the circumstances and what can you do to try and convince people that this isn't going to be one of a range of other things. To the extent that people didn't think it was a one-off, or to the extent that we're talking about an annual wealth tax instead, yes, I think there would absolutely be behavioural responses. Yes, that probably would include some people leaving the country. I think it's very difficult to judge how big those responses are likely to be. There was some work done by this for the Wealth Commission, but for Wealth Tax Commission, but frankly the evidence we've got to go on is fairly sparse, and how far you can carry it over to different circumstances is debatable. I would also say I think it does depend a lot on the design of the tax. Again, there's a big difference between what you might think of as a mass market tax and a tax on the super rich. There's also a big difference if you start layering in lots of exemptions and so on. A well-designed wealth tax would be a lot harder to avoid and likely to lead to smaller behavioural responses, but whether that is what you would get out of the end of a political process, I think is more debatable.
Thank you. Felicity.
Yes, I'll be very brief. The signalling effect, I think, is critically important. You know, we want to be sending the message here that we are open for business, and also we don't want to be almost penalising the well-to-do. We want to be bringing everyone else up. It's all about levelling up as opposed to taking other people down. That is the message. Levelling up is to go from the bottom and take up. And I think that signalling effect is incredibly important.
Thank you. Lots of questions in the room, but just on the fairness to the people who are on Slido and people online, so I'll take the top question at the moment, which is how would you deal with money kept offshore and the risk of people shifting money offshore? So I guess two different questions there. One is about the behavioural effect, which I think a lot of people have talked about. And actually, all I'd add into the behavioural effect question is obviously, I think one of the things you've said, Emma, is that this has to be introduced with no notice. But you know, everybody's asking Keir Starmer last week, are you going to introduce this? So, you know, actually, could we credibly have something which had no notice at all? And then the second part of the question, what about all this sort of magic money tree that's obviously hidden offshore because we haven't found it in the UK yet?
Okay, I mean, even if, yeah, it depends how long your tail is. I mean, if you're saying that you're going to catch people who have been resident for 4 out of the last 7 or 10 years or whatever you want to do, then you obviously, in a sense, it doesn't matter if people anticipate it. because they'll still be caught. I think there's a few myths about offshore wealth, that somehow it's not subject to tax. It is subject to tax. If you're resident here, you pay tax on offshore wealth, and you may say, well, how do people know about it? Well, we have things like common reporting standards and very significant penalties that the Conservatives have introduced, pretty successfully over the last 10 years to stop people hiding money offshore, and that's been a global, an OECD initiative. So yes, people can move it offshore, but actually I think they'll find that they're subject to a higher level of inquiry and penalties, because the penalties are greater if you put money offshore and then you still owe tax. So I'm not particularly worried about that, because we have common reporting, but I don't know what you think.
No, it's an area that I work in as well, and actually there isn't a magic money tree offshore, if that's one message to get out there, with my personal view as well. Anybody want to add to that, or should we?
Well, just briefly, I think in terms of people moving money offshore, an easy counter to that, which the Wealth Tax Commission did say, is don't make the tax based on where the wealth is, make the tax based on where the person is. So holding your wealth offshore doesn't actually reduce your tax liability. Of course, that still leaves open that the people might leave, and some might, but it's a lot harder for people to leave than for people to move their money offshore. The second thing is that if you do that, the issue becomes less about behavioural response and tax avoidance and more about just tax evasion, just illegal hiding of money offshore. And that has definitely got harder over the past 10 years or so. And John and Emma know much more than I do. I'm not sure it's completely non-existent yet.
And I would just make one very quick point. We as Conservatives have actually done a very, very good job in clamping down on offshore tax avoidance, but there is more to be done. And I think fairness needs to be at the heart of our tax system. Everyone should be paying the same pro rata rate of taxation. It shouldn't be that if you're ultra rich, you can call upon the best minds to avoid tax.
Great, thank you. Lots of questions. The gentleman at the back of the corner had his hand up first, and then we'll take the lady also on the same row.
Thank you. Charles Hughes, West Berkshire. 3 swift points. Firstly, Felicity, I thought your presentation was clear, cogent, and I would go along with it wholeheartedly from both a practical point of view and a political point of view. Secondly, we already have substantial wealth taxes. Stamp duty, inheritance tax, capital gains tax. Adding to them would not help and would further confuse the issue. And anyway, the ones we have at the moment, as I think several of you have implied, are a complete and utter mess and really do need to be sorted out. Thirdly, I understand that the wealthy already pay a massive percentage of the tax burden. And I wonder whether Stuart could add to his very illuminating talk by giving us some statistics as to the percentage of tax paid by the wealthy. And the question then is, because I think the answer is very high indeed, the question is then, is it actually beneficial from anybody's perspective to add to that burden?
Great, we'll take the second question. This one. Sorry, down, this lady.
Hi, I'd like to just add that
You're
that's
on.
working.
It is, it's working.
Okay. I think we must only tax when we have a real reason for it. I think just thinking of ways to raise more money only encourages people to think of ways to spend more money. So I think that it's very important, if it's a one-off tax, it has to not only have a one-off purpose but be easy to collect. One of the reasons that HMRC is moving towards PAYE and VAT is because they're incredibly simple and someone else collects them. It doesn't even cost them money to collect. And the real problem with the whole net valuation of housing, you would then have to go into each individual house and see how big your mortgage is, what it's worth, net mortgage, look at what pension things people have gone into. It would actually probably cost more to collect it than you'd get. I don't know if you looked into that in the commission, but I just feel that is the key issue with tax, is make it simple, make it low. If you look at the countries like Hong Kong has a low level of tax, it's easy to pay, and no one argues with it because it's not worth it. You get, and you'd be better off to have a lower amount of tax and collect it easily. And I think having complicated collection process is we're just employing people to collect tax, and then we'll be employing tax accountants to find ways around it. People will be borrowing more, so their net wealth is less. They'll set up charitable trusts and stuff. They'll find a way around it if you make it complicated.
Okay, thank you. If we take Stuart first, maybe on. I don't know if I've given you long enough to dream up some statistics on.
Sure. I'll try not to make up any statistics. The one that I do have in my head that's very widely cited is for income tax, that the top 1% of income taxpayers, which when you bear in mind the big increases in the tax-free allowance, means only about the top 0.6% of all adults pay 29% of all income tax. So that is a pretty big share. Now, if you take the next two biggest taxes, VAT and national insurance, they're nowhere near as concentrated at the top. On the other hand, there are some of the smaller taxes, like capital gains tax and inheritance tax, are extremely concentrated, much more so than income tax. We don't have good data taking it as a whole, exactly how concentrated it is at the top, but hopefully that gives a flavour. That doesn't, of course, say that it couldn't or shouldn't be even more concentrated at the top, or less so. Again, I don't really want to take a view on that. I'd also add, and this speaks to the earlier point as well, want to be a little bit careful to distinguish between what's paid by people with high income and what's paid with people by high wealth, because they're not always the same things, and we don't have very much at the moment in terms of wealth taxes. We have taxes on the returns to wealth, we have taxes on transactions, we have taxes on income from wealth and capital gains from wealth as being the two types of returns. We don't have many taxes on the stocks of wealth. Arguably the closest would be council tax, which interestingly is really not very concentrated at the top, quite the reverse. It's actually the only tax in the current system that's deliberately regressive with respect to its base. And whether you'd want to think about that as a wealth tax is anyway complicated and questionable. However, that aside, I certainly agree we do have lots of taxes that fall predominantly on the wealthy already, and I would absolutely say let's start by fixing those before we even think about doing any new taxes. I completely agree about it. Things need to be easy to collect. Wealth taxes, not easy to do the valuation or to collect it, but if you have a good enough argument for doing it, that you may be willing to bear a certain amount of costs in doing that, as we do with some other taxes.
Emma, do you want to talk?
Yes, I mean we did do some analysis of administrative costs and valuation issues, and those are discussed at some length in the report. And you certainly would raise money from a one-off wealth tax. I think annual wealth tax is also a different beast again. I sense a certain level of scepticism about one-off wealth tax in the room, but if I could just move to the capital taxes generally, I totally agree that they are complicated and they do not work well. And actually inheritance tax in some ways is a tax really borne by the middle class. It's not borne by people with great wealth and landed estates, because they will generally get some form of relief, or else they'll be able to hand on their wealth. And I would say that both parties have been equally remiss in not wanting to touch inheritance tax. And so we have the classic problem of capital taxes, which is a high rate at 40%, high headline rate, and loads of exemptions. And it's strongly resented by people whose main wealth is in their house, and they can't afford to make large lifetime gifts which are tax-free, and they haven't got farms or businesses which are 100% exempt. And that is one reason, I think, why inheritance tax is a very unpopular tax, because it is perceived as unfair. And I think the Office for Tax Simplification did produce some data which showed that it was quite regressive in its nature. you can interpret that data in different ways. But I think if the Conservatives, should look at inheritance tax, I think we don't always agree on how to reform it. But I think we should get better data, because one of the problems about looking at capital taxes, as Stuart said, we don't have fantastic data on holdings of wealth. If you make a lifetime gift, you often don't have to report it at all, particularly if it's a cash gift. And so it's very difficult. If you can't measure it, you can't really tax it in a very coherent way. And I think policy really needs to be informed better on what is wealth and how is it held and how is it transferred in this country. But I would suggest that you could get rid of an awful lot of reliefs for inheritance tax and a lot of exemptions, but you would have to lower the rate. Because if you have a headline rate of 40%, you are going to be forced into exemptions. If you had a headline rate of 10%, which I was on helping an all-party parliamentary group, which was one of the recommendations that we made, you can get rid of pretty much all the exemptions, and including things on lifetime exemptions, and because people don't mind paying 10%, but they really strongly object to paying 40%. But that wouldn't have universal support from everyone, and it's certainly not, by the way, a recommendation of the Wealth Tax Commission, I should hasten to say that, or indeed the Chartered Institute of Taxation, because they'd all be out of a job if we did that.
Good. So just while we're on inheritance tax, and maybe I'll then bring in Felicity with any comments. Actually, one of the next most popular question online was, is there a desire to reform inheritance tax? And I may be bringing Felicity on that question. But the particular question is actually having a genuine inheritance tax rather than an estate tax, taxing unearned income received rather than the estate. So I think there's probably a couple of different questions mixed into that about whether you have a recipient-based tax rather than a donor-based tax as they have in Ireland, or whether maybe you had capital gains tax at death, so that the unearned part gets taxed. But I don't know, maybe you would.
Well, okay, lots to say about that. I think the first thing I would, I think there is a lot that needs changing on inheritance tax. I think there is a decent principled argument to say that we shouldn't have one at all. Fine. If you do have one, there isn't really a good argument for having the exemptions we currently have, and famously agricultural property, business property and so on. What my personal bugbear, because it was a brand new one that was just essentially brand new one that was introduced about 5 years ago, is the fact that if you die with money in a pension pot, that escapes inheritance tax, which never used to be an issue because you used to have to annuitise your pension with defined benefit pensions and so on. It wasn't an issue. But now the tax system is giving you an incentive to finance your retirement using everything except your pension, so that you can pass your pension on inheritance tax free, which just seems balmy to me. I think ideally a much bigger and more difficult reform would be to move it from taxing the estate to taxing the recipient, and ideally to extend it to lifetime gifts as well as bequests on at death or in the 7 years leading up to death. I think ideally you would levy it on lifetime receipts of lifetime gifts as well. That's clearly practically more difficult, although frankly still a lot easier than a wealth tax.
Maybe just coming to Felicity, I mean, one of the questions here, a lot of the answer to a wealth tax is, we should reform other taxes instead. But is there actually a desire in the party to reform inheritance tax? And is now the time to do that?
I think long term there is a desire to look at inheritance tax, but I don't think now is the time, given the pressures that we are under in terms of the fiscal deficit. But long term, yes, absolutely. I think that there is a desire to look at inheritance tax. And I just want to say that I share the concerns about the practicalities of valuation and under-reporting on wealth taxes.
Great. Emma, do you want to just, and then we'll take the question up.
Yeah, I'm a bit sceptical about capital donee-based taxes. They have them in Europe and they don't raise any more money from them, and in fact they raise less money. Ireland doesn't raise any more money, and I don't think that's the problem. I think the problem is the rate and the exemptions, and there's no particular evidence to have a donee-based tax. You have fewer exemptions, or that it's more popular actually. So I think such a wholesale reform would need to be justified by, it would be more credible, it would raise more money, it would be fairer. I'm not convinced that it would be ultimately perceived in that way, and I think you might end up with the same problems.
Great. Thank you. So we'll take a question from the chap in the back corner there, and then the chap on the aisle.
Hi, Rob Harris from Pudsey. Picking up one of the points that's been talked about in terms of transferring assets abroad if there were wealth tax to come in, there's quite a lot of countries around the world that have an exit charge which stops you being able to take a tax benefit from that by imposing a charge when you go non-resident. So it would be one way of dealing with it. However, I have to say the signalling issue here is the big problem, because that traps wealth that's already here, yes, but it stops wealth coming back into the country. That's a fundamental issue with it. The one that has always bothered me is the unearned gains on unearned income and unearned profits. So houses. So I became a first-time buyer 2.5 years ago, and my property's worth £70,000 more now than I paid for it. I've done absolutely nothing to deserve that. I think there's a question here. If we're saying we need more revenue, do we need to look at the principal residence relief on money that I've done absolutely nothing to justify earning, as a potential way of sorting this out once I sell my property and have that cash to pay the tax, which is going to be very unpopular. But it's just
I was going to say that's a very brave comment at the Conservative Party conference. But
thank you. Sorry, I'm Joe Rich from Saffron Walden, and I had a very, very interesting conversation with Emma on the way here. And I know we're both barristers, so we had a lot to talk about. Barristers do. But we come to this from very different perspectives. I respectfully agree very profoundly with what Charles from West Berkshire said. I do think any sort of wealth tax is a very un-Tory tax. There is a very great danger of it becoming like income tax, and it being a one-off tax that we're still paying now, long after the Napoleonic Wars have ended generations ago. There's a danger of wealth tax being an opportunity for surveyors to write their own checks for generations to come out of valuing people's properties. And whilst we come from very divergent views, I respect the fact that you've concluded that a one-off tax might be possible with all the attendant set-up charges that would engender. But more than that, there would be a danger that if we no longer had a Conservative government in this country, that John McDonnell or someone like him would adopt such capital taxes very, very readily and maybe move towards a communist society where wealth taxes are 100%, maybe on an annual basis. So in terms of bundling it for a more moderate audience than Jeremy Corbyn, John McDonnell, and those who surround them, how can you guarantee us that your one-off, and I am going to use the word wealth tax, your one-off wealth tax wouldn't become like income tax? And how can you bundle it up so that the fishermen of the Ile de Ré don't become the fishermen of the Bournemouth coastline? Sorry, I say that because the fishermen of the Ile de Ré are people who live in houses that are worth millions of euros notionally, but they're actually people who live in great poverty. And they're forced to pay capital taxes in France that obviously vastly exceed their ability to do so from the simple fishing occupations that they engage in. I'd be very grateful, Emma. Thank you very much. And thank you very much for thinking about this so profoundly. And I know you respect the fact that I have too.
Great. I'm not quite sure what questions there were in those, but
how do you bundle? I might just on the capital gains tax main residence. Funnily enough, Nigel Lawson thought about this after he introduced the potentially exempt transfer regime. He said to I have the notes in his very distinctive hand, which you can go to Q and see. And he said to his civil servants, "Now we've got pets, why don't we abolish main residence relief on houses?" And one of his civil servants said to him, and this was sort of 1987, "I wouldn't bother because house prices have reached an all-time high. They'll never get any higher." And then he said, and I think it's probably influenced, if you want to go on your travels into retirement, this would be a good way to do it. And we didn't hear any more about it after that. So it certainly occurred to such an inquiring brain as his to have main residence relief restricted or abolished. I mean, there may be a case for main residence relief to be restricted in some way above a certain limit, but of course it doesn't necessarily, I guess you'd say, feel very Tory. But obviously there are untaxed gains there. I mean, Stuart may want to say something about that, I don't know, about main residence relief or the pros and cons of it.
Yeah, so, well, I guess there's two things there. First of all, what would you generally with capital gains tax, and then second about main residence relief specifically. And my view is that, broadly speaking, capital gains should be taxed at the same rates as income, but what we need to do is to ensure that that doesn't discourage saving, investment, entrepreneurship, and the way to do that is by changing the tax base so that we're actually giving more generous deductions for the amounts that people save and invest, and we're giving proper offsets for capital losses so that we don't tax gains more than we deduct losses, and things like that. And I've written at length elsewhere about how you would go about doing that. That's what I would do in general for capital gains tax. In principle, I would say the same for people's main homes, that yes, do tax it, but one way to do what I'm talking about is when you do the purchase price of the home should be stepped up not only with inflation, which is how the old indexation allowances in capital gains tax used to work, but with an interest rate, which doesn't sound very generous now. Interest rates are near zero, but in other what you might call normal times actually makes a big difference. A big difficulty though with doing that for main homes is whether it's credibly long term. The problem that we've had with things like that, and you get similar problems with things like planning gain supplements or development land taxes, is if people start thinking that the next government might repeal it, they just don't sell their house. And in which case you've really gunged up the housing market, and it can become a self-fulfilling prophecy if it messes up the housing market so much that the government panics and feels it has to back down. So I think you would need somehow to try and figure out how you could make people believe that this was here to stay, and therefore there's no great benefit to just delaying the house sale.
Great, thank you. We've come to the end of our time, I'm afraid, but I'm going to leave the last word to Felicity.
Well, I just want to thank everyone for coming and for being so engaged. I think that we've had a great debate, and thank you for all of your expertise.
Great. Well, thank you all very much for coming. It's been really good. So thank you.